Welcome to Friday Takeaway. The market wasn't great this week, but MyEG and DNex seem to do okay. Speaking of doing okay, the Trump administration pushed through a major tax reform that it claims is a big Christmas present for the people, despite the fact that 52% of adults are against it. Ultimately, though, it slashes taxes for corporations and the wealthy while offering mixed temporary relief for the working class. So, mega? The European Court of Justice ruled that Uber is indeed a transportation firm and not a digital company as it has always claimed to be, which has helped to protect it from some national regulations. With this ruling, Uber now has to comply with European transport laws. Felda is at risk of losing a piece of land it owns in Jalan Semarak worth 200 million ringgit following what has been described as a dubious deal. Apparently, according to the papers, the land title was transferred in a questionably dodgy transaction in 2015. With the clock fast running out on 2017, the market is not having the best of weeks, lower than last Friday's close by 0.1%. It was trading at 1,750.99 points this morning, higher than it was on Wednesday, but no question that most people have seemed to have checked out ahead of Christmas. Moving on though, MyEG did some shopping this week. Most should be familiar with the name MyEG. It is an e-government services provider, meaning that if you've ever done your road tax or paid a fine, you would have used them. Its managing director is Wong Tian Soon. MyEG announced that it was buying a 23.5% stake in a company called Stampede Holdings for 10.4 million ringgit, which owns a debt collection system called Volare, which automates and standardizes key collection processes. And earlier this month, MyEG had been granted a money lender's license for a period of 2 years, and it will allow the company to carry out money lending services, no surprise, that complements what it does now. Analysts didn't seem that impressed with the Stampede buy given that it was only an associate stake, and despite the fact that it's been investing in a raft of technologies, any contribution will only come later. Plus, MIDF research says that it expects the dividend yield to be unattractive at approximately about 1%. The stock saw a kick with the news and is actually this morning just 4 cents beneath its one-year high and was trading at levels it hasn't really seen recently. On the whole, up though from a year ago. But overall, analyst consensus is leaning more towards hold than buy, with top target price being 3 ringgit and 4 cents, while on the more conservative side, it's 2 ringgit 10. For those who follow DNex, this week's news must have seemed like validation. Formerly known as Time Engineering, this company has been around since 1970. Today, it has two main businesses, namely in energy and IT and e-services. So, government has awarded another year of extension to its contract for what it calls the National Single Window for Trade Facilitation. It has been handling this job since NSW was actually launched in 2009. Now, the charges, what they actually charge them to use it, haven't really changed, but overall, it will be positive on earnings. The main thing that analysts are pointing out though for DNex that its energy sector remains an issue. While better ONG prices will actually point to a re-rating for the company, any downturn or slower recovery could put major pressure on earnings. Looking at a shorter time frame for DNex, it is below $1 after all. It's within spitting distance of where it was 3 months ago, but overall still lower. But on average, the stock is trading around about 40 cents. Analysts seem on board though with the company. Most are recommending buy and the top end of the target price is 74 cents.